Something unprecedented just happened in the silver market, and almost nobody noticed. On December 12, 2025, at 2 in the morning, the COMEX exchange raised margin requirements on silver futures by 10%. This wasn't an accident. It was a desperate attempt to force traders to panic and dump their positions. They needed the price to crash. But here's what's crazy. Silver didn't crash. Instead, 67 million ounces of paper silver got sold in minutes, and physical buyers absorbed every single ounce. Less than a week later, silver hit new highs above $66. Today, it's trading around $72 per ounce. That's a 120% gain for the year. What we're witnessing isn't just a price surge. It's a liquidity crisis exposing a massive problem in the global financial system. Banks are scrambling to cover positions. Physical silver is vanishing from vaults, and the paper market that's controlled prices for 50 years is starting to break. Let me show you exactly what's happening. When the CME board raised margins at 2 a.m. on a Friday morning, it was a calculated move. Raising margins forces leveraged traders to either put up more cash immediately or have their positions automatically liquidated. It's a mechanism that's been used for decades to suppress precious metals prices. The COMEX was created in 1974, 3 years after Nixon removed the United States from the gold standard. Without gold backing the dollar, they needed a way to keep precious metals prices under control. They created the futures market, a paper casino where banks could short massive amounts of silver without actually owning the physical metal. For 50 years, this system worked perfectly. Whenever silver started rising too fast, they'd raise margins, trigger liquidations, and crush the rally. They did it in 1980 when silver hit $48. They did it in 2011 when silver approached $50. And they just tried it again on December 12th. But this time was different. The sell-off didn't stick. Physical buyers absorbed the entire dump in minutes. This tells us one critical thing. Demand for physical silver is now stronger than the COMEX ability to manipulate prices with paper contracts. So what's causing this unprecedented demand? Central banks. Russia, India, and Saudi Arabia have all started buying silver for their reserves. This is massive. For decades, central banks only accumulated gold. Silver was ignored. But now, sovereign nations are treating silver as a monetary asset again. Russia has been buying for 18 consecutive months. Saudi Arabia just made its first ever silver purchase. Why? Because they're diversifying away from the US dollar. They want hard assets that can't be printed, frozen, or sanctioned. Silver is cheaper than gold, more accessible, and it's in critically short supply. Industrial demand is the other massive driver. Solar panels, electric vehicles, electronics, semiconductors, and solid-state batteries all require silver. There's no good substitute. Global silver demand has exceeded supply for 5 consecutive years. The Silver Institute projects a deficit of 95 to 120 million ounces in 2025. The cumulative deficit since 2021 is nearly 820 million ounces. That's more than 10 months of total global mine production just gone. Mine production is stagnant at around 813 million ounces annually. Most silver isn't even mined for silver. It's a byproduct of copper, zinc, and gold extraction. You can't just ramp up production. It's structurally inflexible. And demand keeps accelerating. Here's where things get really interesting. London, the world's primary physical silver trading hub, is experiencing a full-blown shortage. In October, silver lease rates in London spiked to over 200%. Let me repeat that, 200% annualized rates to borrow silver. Normal rates hover near 0.25%. When they explode to 200%, there's virtually no physical metal available. The Swiss refiner Metalor announced they would not return to the London market until January 2026. Major banks withdrew from quoting prices. This isn't normal market behavior. This is panic. COMEX silver inventories have been draining at historic rates. Over 2 weeks in mid-December, inventories dropped by more than 20 million ounces. That's the largest decline in 25 years. Traders are airlifting silver from New York to London to ease the squeeze. India's role cannot be overstated. In October, India imported 1,715 tons of silver. The trigger was an Indian influencer who posted that silver was undervalued. His message went viral right before Diwali. Traditionally, Indians buy gold for Diwali, but this year they pivoted massively to silver. Silver premiums in India soared to over $5 per ounce. Multiple Indian silver ETFs had to suspend new subscriptions because they couldn't source enough physical metal. Banks are trapped. Many financial institutions hold massive short positions in silver. They've been betting against silver for years, selling paper contracts without owning the physical metal. But now, COMEX vaults are depleting rapidly, and banks can't find physical metal to cover their shorts. The margin hike on December 12th was a desperate attempt to shake out long positions and give short sellers breathing room. It failed. When 67 million ounces of forced selling got absorbed instantly, banks realized they're facing a problem they can't manipulate away. This is the billion-dollar liquidation. Banks holding short positions are panic covering. They're buying back contracts at any price because they can't risk being forced to deliver physical metal they don't have. Every time they cover, they push prices higher. This creates a vicious cycle. Higher prices force more shorts to cover, which pushes prices even higher. Analysts are calling this a liquidity event because it exposes how illiquid the physical silver market truly is. Paper contracts created the illusion of liquidity for decades, but when everyone wants physical delivery at the same time, the system breaks. The gold to silver ratio is around 65 right now. During previous silver bull runs, this ratio has dropped below 40. If that happens again, with gold currently above $4,400 per ounce, a ratio of 40 would put silver at $110. Major banks are updating forecasts. Bank of America raised its 2026 silver target to $65 per ounce. Technical analysts are pointing to targets between $77 and $88. More aggressive forecasts suggest silver could reach $100 or higher if supply constraints persist. The Federal Reserve's policy is adding fuel to this fire. After 3 rate cuts in 2025, markets are pricing in 2 more cuts in 2026. Lower interest rates reduce the opportunity cost of holding silver and weaken the dollar, making silver more attractive to foreign buyers. Here's what makes this explosive. Silver has broken out of a 45-year consolidation pattern. Technical analysts are calling it a cup and handle formation, suggesting silver is entering price discovery mode with no clear resistance levels above. The bottom line is this: the silver market is undergoing a fundamental transformation. The era of COMEX paper contracts controlling prices is ending. Physical scarcity is asserting itself, and banks that bet against silver for years are now scrambling to exit positions before losses become catastrophic. The billion-dollar liquidation isn't coming. It's already here. You're witnessing a historic shift in how commodity markets operate when paper promises meet physical reality.